G'day guys, thanks again for joining us for another Catapult Wealth Market Update. Once again we have the honour of having David Bassanese, who's the Chief Economist at BetaShares. Adelaide lad, Harvard University graduate, used to work for Treasury. Thank you very much for your time.
Yeah, no, great to be here, great to be with you all again.
Mate, I think the big one that everybody's talking about right now is obviously all this chaos around the banking sector. It started off with these sort of crypto-related tech banks, which wasn't such a big deal because they were doing sort of stuff that normal banks don't do. But now, obviously, we're seeing it with Credit Suisse and a little bit of talk around Deutsche Bank, which makes it a little bit more real. I just wanted to grab your thoughts around what you think in terms of like how risky this is, and perhaps a bit of a talk around the difference between some of these big overseas banks and our local banks.
No, good. So obviously it's topmost of investor minds at the moment. Look, my assessment here is that we are seeing a case of some rogue banks, going under. You mentioned Silicon Valley Bank, and there's a couple other banks in the US which had on various metrics of risk were pretty extreme. Most other banks in the US weren't carrying the type of risk that they were carrying, so they were most exposed to the increase in interest rates, the problems in the tech sector, and then problems in the cryptocurrency area as well. Without going into the details, that they were pretty much sort of exceptional cases, and the policymakers in the US have done, to the extent there's lingering concerns with some of the banks, they've put in lending facilities that should prevent other banks facing deposit runs. So I think the situation, as best we can know, is sort of contained in the US. And certainly the big systemically important banks, as we call them, like the Goldman Sachs, the JP Morgans, they are better, more strongly regulated, better capitalised, certainly not facing the sort of risks that we saw with the GFC over a decade ago. In Europe, Credit Suisse to an extent was a bit of an exceptional case as well. It's probably one of the most vulnerable, unprofitable banks in Europe. And unprofitable in the sense that they were actually making good, reasonable underlying profits, but they have a lot of legacy of fines to pay for like bad behaviour. So probably one of the less well managed European banks. Deutsche Bank also has had risks in the past and has had a history of some scandals as well. So I think investors were looking around for the next vulnerable bank and sort of picked on Deutsche Bank. But their profitability again, seems okay. So I don't think we're on the cusp of a GFC Mark II, but I think what we are seeing is some of the fragilities in the system emerging on the back of rising interest rates globally, slowing economic growth. But otherwise, I think as best that we can know, it should be relatively contained. Doesn't mean there aren't challenges out there, but it won't come from a blow up of the banking sector.
Hopefully, yeah. But speaking of which, I mean, when we think about what's going on overseas compared to Australia, I mean, would you agree to say our Australian banks are some of the strongest in the world?
Just in terms of the last element of your question, so our banks are, very strongly capitalised. In fact, many of them, our banks generally have a simpler business model. They're basically, take in deposits at a margin and lend it out as home lending is their bread and butter, and they don't really get involved in the big trading, investment banking type activities that does cause a lot of problems for banks, for the big banks in the US. So it has historically caused problems with global banks, and even the ones that did face trouble in the US, they had, again, without going into the details, very extreme exposures in terms of uninsured deposits, a lot of assets that were basically carrying a loss that they were going to have to realise a loss on when they sold. Our banks are at risk if we get a major implosion of the housing sector and default rates on home loans go through the roof. But barring that, which I don't anticipate, they're pretty well, certainly relatively immune to what we're seeing globally.
Yeah. I mean, our capital ratios, they're kind of always in excess of the requirements.
Yes.
And the banks look to be already moving to talk to some of these homeowners who are potentially going into negative equity and saying, hey, the property market's still okay. If you're going to make a move, now's the time. So there's things happening in the background. So.
Yeah, exactly.
Yeah. So the other big question that everybody's asking is what's going on with interest rates, because we have Jerome Powell coming out and saying, look, guys, we might be coming close to the end of the rate rising cycle, but don't anticipate rate cuts this year. But the bond market is once again not listening to him at all. Yeah. Can you give sort of your predictions on where the Fed's going and maybe where the RBA is going as well?
So look, at the end of the day, the bottom line for the US is it's still, the economy is still strong, still too strong, inflation's still too high, labour market is very tight, wages are very high, growth is high. So basically, one way or the other, the US economy needs to slow and potentially have a recession. We're still debating, does it need a recession to get inflation under control? So that is that end problem that the US still faces. Now, in terms of what the Fed will do, it really depends on credit. To the extent these banking troubles in the US cause a tightening if banks themselves start to rein in lending out of caution, which slows the economy, it means the Fed needs to do less. But if the banks don't do that, if this financial instability we've seen of late goes away, then the Fed is still on track to have to do what they need to do. So, to be honest, I'm not sure how far the Fed needs to raise interest rates. What I do know is one way or the other, which is of most relevance for equity investors, that the economy needs to slow. And there's still, I think, a significant risk of a recession over the next 12 months. But in terms of bond markets, I actually think the Fed, I don't see rate cuts. I think the economy is still too strong. Unless it does tumble into recession, quickly in the next few months, then you might get rate cuts in the second half of the year, but only under that scenario. So at the moment, I've got the Fed raising rates, in fact, raising rates again in May, possibly further, because I do anticipate the financial issues to go away, but one, possibly two rate rises, and then on hold for the rest of the year, and then and then I think that will be enough to see the economy slow, and then eventually, you'll get the Fed reversing course and cutting rates. But I stress, not before the economy does slow. So it's not particularly good news for equity investors in that sense. Don't count on the Fed saving you, because there's still something that needs to happen in the economy first.
Because what the bond market seems to be anticipating is quite a sudden jag. So they must think that inflation's really going to come back here dramatically.
Yeah, the bond market thinks either two things. So as you said, the bond market is now pricing in no more Fed rate rises and then pretty aggressive rate cuts soon. So that can happen in two ways. Either the economy, the credit, the financial banking problems that have arisen cause a recession quickly, and so the Fed has to come to the rescue and cut rates, or inflation drops surprisingly fast. And again, given the tightness of the labour market, given the strength of wages growth that we're still seeing this, I don't see that happening. But that's the two scenarios under which the bond market would be right at the moment.
So it's interesting because during times of volatility, people flow to the USD, but our banks are fine. It's their banks that are more at risk. But in saying that, what's your prediction for the RBA?
Yeah, so unlike in the US, we are seeing signs of a slowing in growth in Australia. And one of the reasons, so more mortgages in Australia are variable rate. Most mortgages in the US are fixed rate and fixed for like 30 years. So although the Fed been raising rates, it hasn't had a big impact on mortgages in the same way it has in Australia. So no surprise that we are starting to see finally consumer spending slowing down, which is what the RBA wants to see. And so I think we are close to an end. So I've got them, either raising rates once more in April and then announcing a pause, or basically not raising rates and announcing a pause. So either way, I think we're close to the point where the RBA will signal a pause at least for 3 to 6 months, see how the economy pans out over that period. But I actually expect once you've waited that time, there will be more signs of slowing in both our economy and the global economy, that they won't need to raise rates anymore. So yes, we're close to the end in terms of the rate rises here in Australia. Okay.
Well, just to summarise all that, given that the Australian economy, the Australian stock market very much follows the US, what's your prediction next 12 months for markets?
Yes, I mean, my bottom line here is that the US economy still needs to slow more than the markets expect or anticipate. So I do think the market is probably at risk of another leg down, which will probably make it challenging for our market as well. So if the US sneezes, we catch cold. And I think, there is a pretty big sneeze happening. The US will need to sneeze later this year, and our market's probably going to catch cold as a result.
Yeah. Well, it's interesting. So, as bond yields come down, that's generally good for asset pricing, but it's the reason why bond yields are coming down. And so we'll just see what's happening. It's all about spreading it out and diversifying it. So
Exactly.
David, thank you very much once again, and thank you guys for joining us.